Hey everyone, D-Cope here to welcome you back to IPA Day 5. And I'm pretty excited about today because I get to talk up some friends of mine and also some people I'm sure we'd all like to get to know a little better. This is actually a really important part of mindset, and this idea will help you succeed in any industry you want to. Even if you don't know anything about that industry yet, it's an industry that's new to you. So, this is the last day of week one, Mindset of a Trader. So, tomorrow we'll be moving on to mechanics of the market. And that's fine. If you want to take a weekend break, that's fine. So far in week one, here's the outline. We've covered a lot, like the most important things, alchemy of self, trader tools and measurements, and where you want to be. Today is where we look at the greatest of all times. And this acronym is GOAT. Now, these GOATs are rather subjective by me, as in I handpicked this list. So these are guys I feel most aligned with, and they're the ones doing it best right now, in my opinion. You may disagree, and that's fine. These GOATs have a wide range of net worth. Some are not even billionaires yet. I'm sure some of you that have been trading and investing for a long time have your own GOATs that you look up to, and you know what? That's awesome. I love that idea. Keep following these greatest of all times. Now, these are just the examples that I want to highlight because looking at the best is always a good idea, and because I genuinely like what I know about these people, and they all have a great story, which we learned yesterday is pretty important. So this is going to be a nice, easy day. I'm going to just tell the stories of 6 people that I want to highlight, and then I'll let all of you out of here so you can enjoy your weekend. So here's the outline for day 5. That is Tim Sykes, Ross Cameron, Peter Lynch, George Soros, Warren Buffett, and Jeff Bezos. Now, it's important to understand that each of these people has their own styles of business that they operate in. And basically, they all actively manage their positions, but in completely different ways. So I tried to pull a range of styles to highlight different options for you moving forward as we try and create your plan in week 3. So you want to pay particular attention to each style. So I'm just going to tell their story, then I'm going to try and describe their style and their mindset so that you have some ideas on where you want to go and where you want to take your trading business. So I'm just going to tell each of the stories right now. This first guy, Tim Sykes, he truly has a passion for trading. You know, in the beginning, it was he wanted to make as much money as he could in the shortest amount of time, and start building wealth for himself. He started first trading with his bar mitzvah money in high school, in his high school library. And in his book, he describes stories of doing research on the internet and having to wait till the web pages loaded. So this is how long ago this guy was trying to do this in the market, similarly to what I'm trying to teach here with a super high return on investment. So he went on to make hundreds of thousands of dollars out of his college dorm room. And I'm pretty sure that the book said that he made around 800,000 in trading profits his freshman year of college. So his book is called An American Hedge Fund. He describes the opportunity during that time and how he had a perfect strategy that he kind of ruined by telling everybody about it in chat rooms. So everyone was trying to do the same thing, and he kind of tipped people off to his strategy, and he had to evolve his strategy. He was a major believer in educating people about the market and also enjoying the fruits of his labor. So that's basically Tim Sykes' story. He also tells about how he got himself into trouble as well with his hedge fund, and he doesn't hold anything back. He really tells it like it is in hopes that the reader will not make the same mistakes. So that's a pretty common theme amongst these goats as well. So the next goat is Ross Cameron. Also, pretty great story. So Ross demonstrated the highest return on investment I was able to find anywhere in the market when he turned $576 into over $100,000 in 44 trading days at the beginning of 2017. So I did a rough calculation of what that return on investment was approximately, and it's 17,700%. That's per year. That's extrapolated out per the year. So that's an average daily gain of 12.5%. However, there were days when he lost money. It was a roller coaster for sure. And of course, he's been doing this so long that he truly is a master of trading. So he was also using a SureTrader account, which allowed him to leverage his positions. I guess that's why they call it SureTrader, because you're sure about the trade. Nevertheless, so I had to revise my thoughts on what was possible when you make the definite decision to actively manage your daily positions. Now, obviously, there are limitations to continue this growth rate. It only works growing it up to a certain point. So, growing a large account is just not the same as growing a small account. You just can't expect the same percentage returns, and there are other factors like how much you feel comfortable risking. So, to put things into perspective, Ross's biggest day was around 33,000, I think, which is probably about double his biggest losing days. I know Ross is a firm believer in making sure that your risk is half your reward. So you want your reward to be double the risk that you're taking. So now Ross knows his statistics very well, and you have to if you're going to be risking that much a day. Now, 33,000, that's a huge day. It takes most people 3 months to make that. That's 90 times as long. To do a strategy like Ross's, you need in-depth knowledge of platform setups. I know he has hotkeys set up, so his execution is really easy. He's in and out with one click of the button, so it's almost instantaneous. That's really important for day traders if you're going to go that route. Now, there's also a level 2 aspect of the market, which Ross pointed out to me. It's when you can see the live orders coming in. So you see the bids coming in from the buyers and the limit orders from the sellers. So these orders coming in as they get put up on the board, this can be very revealing and hint toward where the market really wants the price of this stock or this underlying security. So right now, I'm giving major props to Ross for showing me that these returns are possible with a small account in the stock market. And I would recommend his course to anyone attempting to learn the day trading style. So let's move on to Peter Lynch. Now, here's a great story. It's a great old story. So the science of the market, it was discovered long, long ago. It was discovered even before Peter's time. The value lies in the practical application and the execution of the strategy. Sometimes it doesn't matter. You could have the best strategy in the world, and if you can't execute it, then it's worthless. So Peter ran the Fidelity Magellan Fund between 1977 and 1990. Now, during this 13-year period, the fund posted an annual return on investment of 29%. So he built the fund's assets from 20 million to 14 billion. This was the best 20-year return rate of any mutual fund in history. It's crazy how one masterful trader can amass a fortune for a great cause. This man took a very small management fee and no performance bonuses. He was, however, obsessed with the market. I'm going to talk about Peter's strategy. It's just a great one. It's one of the best. So he only spends 15 minutes a year on economic analysis. He says, invest before you investigate. The essence of his technique is fluency, letting his ideas flow from one to the other. He notices some apparent opportunities in the market and acts on them without delaying for extensive analysis. So the portfolio that he managed consists of 1,400 holdings. The largest 100 represented about half the capital. The largest 200 represented 2/3 of it. On a typical workday, he oversaw the transaction of about 50 million in purchases and 50 million in sales. To conduct this operation, he had 3 traders. One person did the buying, one person did the selling, and one person understudied both. Ordinarily, there would be 100 orders on each sides of the books. That is 100 orders to buy a stock if it got cheap enough, and 100 orders to sell a stock if it got high enough. So if the stock moved away from the orders, he withdrew his bid or offer. So less than 5% of Lynch's trades were bigger than blocks of 10,000 shares. Now, most institutional investors, I would say, are trading 100,000 shares, block shares minimum. I thought that was very telling because he's definitely doing things differently than how most institutional investors. Peter's policy is to seek profit from what many investors would consider minor price anomalies. And I just love this philosophy too. So he suggests using solely balance sheet analysis is inadequate and that very cheap statistically can be a real trap. Book value can be hopelessly misleading, he says. So all the tips he ever got on takeover rumors were wrong. Like all of them. The guy traded for 13 years and he said he went 0 for 200 on takeover rumors. He also said, when the news seems terrible, that's when you make the big money in the market. He was a big believer in the old trader rule. If you buy a stock because you hope something will happen and it doesn't happen, sell the stock. So all of his trades fit into 4 categories. The first is growth companies, where he would expect to make 2 to 3 times his money over time. Second was underpriced asset plays, value stocks. Third was special situations and depressed cycles, and we'll get into that next week when we talk about seasonality. And fourth was defensive plays, which he held in preference to cash. In a way, Lynch is saying that if a stock is cheap, that's a much higher degree of reality than some vague notion as to what the market will do next year. You don't get there if you don't love it so much that you'd rather do that than anything else. So, delight in your craft was also a main message. Next is George Soros. Now, George has many great stories. However, there's one that just stands out from the rest. If you've been a trader for a while, you probably already know what I'm talking about. It was the trade that cemented his reputation as the best currency speculator in the world. And don't worry, if you don't know what I mean by currency trader, day 1 of next week is all about currencies. So the next class, I'll be talking about all the currencies to trade. So back to George's story. It was an event in the market where he was seen as the driving catalyst for the move. The event came to be known as Black Wednesday in England. So I'm going to tell the whole story. It's a little involved, so just concentrate a little bit on the facts that I'm going to say. So the British pound shadowed the German mark leading up to 1990s, even though the two countries were very different economically. Germany was the stronger country despite lingering difficulties from reunification, but Britain wanted to keep the value of the pound above 2.7 marks. Attempts to keep to this standard left Britain with high interest rates and equally high inflation. However, Britain demanded a fixed rate of 2.7 marks to a pound as a condition of entering the European exchange rate mechanism. So many speculators, George Soros chief among them, wondered how long fixed exchange rates could fight market forces, and they began to take up short positions against the pound. Soros borrowed heavily to bet more on a drop in the pound. Britain raised its interest rates to double digits to try to attract investors. The government was hoping to alleviate the selling pressure by creating more buying pressure. Paying out interest costs money, though, and the British government realized that it would lose billions trying to artificially prop up the pound. It withdrew from the euro exchange, and the value of the pound plummeted against the mark. It's rumored that Soros made over $1 billion off this one trade idea. So, for the British government's part, the devaluation of the pound actually helped, and it forced the excess interest and inflation out of the economy, making it an ideal environment for businesses. So before you go thinking that what Soros did was wrong, or it's evil, or no one should be making that amount of money in one trade, Soros is not the bad guy. Remember that Soros is actually the good guy here. Soros was bringing truth back to the market. And that's how you need to think of when you make money in all your trades. You want to be bringing truth back to the market. Now, there's a lot of nutty things that will happen in the market, and those who restore truth are the ones that are profiting wildly. So, a country can benefit from a weak currency as much as from a strong one. With a weak currency, the domestic products and assets become cheaper to international buyers and exports increase. In the same way, domestic sales increased as foreign products go up in price due to the higher cost of importing. There were very likely many people in Britain and New Zealand who were pleased when speculators brought down the overvalued currencies. Of course, there were also importers and others who were understandably upset. A currency speculator makes money by forcing a country to face realities it would rather not face. So, I got to give it to Soros for doing what no one else would do in the greatest currency trade of all time, for sure. So, he had these ideas. He had many ideas, and he was also a writer. And he says the markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected. He also said, once we realize that imperfect understanding is the human condition, there is no shame in being wrong, only in failing to correct our mistakes. He goes on to say, stock market bubbles don't grow out of thin air. They have a solid basis in reality, but reality as distorted by a misconception. So that's George Soros, and he's a big influencer in the market. You don't want to be betting against these guys, You want to be betting with them. So the next is Warren Buffett. I'm pretty sure we all know who he is, but I'm sure not all of us have taken the time out to really study his success and what made him so successful, that he's one of the richest people in the world. So for over 60 years, he says, I've been able to tap dance to work, doing what I love doing. That's what he said in early 2017. So his story is pretty well told. He became a player in the investment game at the wee age of 11, eventually using cash he earned from his paper route to buy some farmland in his home state. As a high school sophomore, he also reaped the rewards of a booming pinball machine business that he created. So he's known as the Oracle of Omaha and is currently tipping the wealth scales at 73 billion nowadays. I think he's the third richest person in the world right now. So Buffett's a well-known investment guy. That's his strategy, buy and hold. When Buffett was in his 40s, he didn't have hundreds of millions of dollars yet, actually. It's this compound interest that has, as of recently, really been scaling up. So just do a Google search for Buffett's net worth over time, and you can see how he truly grew into one of the richest people in the world. So the last man, I believe he is the richest man in the world nowadays. I love everything about his story and his strategy. And that man is Jeff Bezos. So the secret to Jeff's success is summed up in the following quote. He says, "Try to imagine what a project or company would be like if it was more successful than you could ever imagine." The message is that even if it's unlikely, soaring success is always possible. There's that famous picture of him in his first office space grinding away with that Amazon.com wooden board hanging on the wall with the orange spray paint that says Amazon.com. And he's working at his computer. You see all these wires exposed everywhere, and he's sitting at a desk that he made from an old wooden door. And this was all part of his message and how he lived. He wanted to send that message to the world as it doesn't matter what it looks like. You know, as much as you've seen this guy in the news lately, it wouldn't surprise me if you never heard that, you know, he actually hangs his hat on being austere and being practical. You know, he spray painted the company name and made that desk from that door to demonstrate the austerity of Amazon.com. It doesn't need to look good. It's all about functionality. He didn't say make it prettier. He said, what's the fastest, cheapest way I can make this work? Then, you know, he acted and he executed really well, and he had conviction and confidence in his strategy. You know, he was in front of the cameras saying the internet's growing at 2,000% a year. This is the data we need to be looking at. So, I mean, the big truth that he brought to life is that, you know, in the end, no one really cares how it looks as long as it works. And I do believe that to be true as well. I just remember that one scene in Tommy Boy. And if you haven't seen the movie Tommy Boy with Chris Farley, you should probably watch that because it's a great movie. But there's one quote in there that so his dad was a salesman in the movie, Big Tom, and the Big Tom's trying to close a deal at his wedding, and the client's, you know, giving some resistance. And Big Tom says in an epic line of the movie, "I can get a good look at a T-bone by sticking my head up a bull's ass, but I'd rather take the butcher's word for it. Wouldn't you?" And that was also, in essence, the basic truth that does it really matter how it looks if you're getting results? So these people that do care about their presentation and their looks, and they can't stop talking about how something looks, and they want you to fix it and make it look a certain way, you need to be asking yourself, is this affecting the bottom line? And would I get different results if I changed this? So the only thing that matters is results. And, you know, this is painful to hear sometimes. But you have to focus on what matters and tune everything else out. You know, you got to delete all the apps off your phone. Stop responding to emails right away. Block access to web pages you frequent that aren't getting you anywhere. Do what you need to do to focus on what matters. And, when you do this and you start making these changes in your life, you're going to get a lot of pushback, and people are going to resist you, and they're going to try and influence your decisions. People laughed at Bezos. They said Amazon.com will never make it. No one's going to buy books online. He said, nevertheless, I think I'll categorize and organize every book in the world. And he continued to build the biggest online library. In the beginning stages, he pitched the idea to over 60 investors and was turned down. In the end, it was his parents who lent him $300,000 of their retirement money to serve as some of the original seed money in the company. And he told his parents he wasn't sure that the company was going to succeed. I think I saw a documentary where he was saying, he thought that there was a 70% chance that he would fail. Now, they don't sound like great odds, but then again, maybe he was just being real. In the end, his parents ended up making excellent return on investments. So, it was a happy ending. Of course, it's easy to believe and have faith that someone close to you, like a daughter or a son, can do it. Now, I'm not saying to ask your parents for money. I'm saying, if you're that parent, that faith and that belief is very important. And even if you don't have any money at all to lend, it's important to encourage with your actions. So Jeff was no doubt a long-term thinker as well, as he could visualize the collapse of bookstores. And some of you may be saying, oh, that's horrible. He put all these bookstores out of business. So it's funny how people view things. The market doesn't care about your feelings. The market's going to do what it must to continue in the most efficient manner. Those that can work out the efficiencies sooner than others will be greatly rewarded. So Jeff brought truth to the fact there are inefficiencies with getting in your car and driving to the bookstore and finding any book in the world in that one particular store near your house and purchasing the book and bringing it home and reading it. So when you detail the situation out like that, it seems obvious to me that there's a lot of value in being able to ship books to people's houses. Yet people still resisted. Amazon.com is just another .com bubble, is what they would say. Amazon went public in 97. We forget it ramped up to $100 a share within a couple years in 1999. That was more than fivefold from the IPO price. And then it collapsed back down to under $6 a share at one point in 2001. So it lost over 96% of its value from its high in a couple years. You look at that price movement there, and it doesn't seem indicative of a great future. But there was something much, much different in this situation. Something was much different indeed. It's important to realize just one person with one belief can bring truth to the entire market, that he or she can really be rewarded with the greatest wealth that anyone has ever seen. So I'm sure all of you know Bezos. However, you may not know that Jeff has a pretty big project in the works deep inside of a mountain on one of his properties in Texas. So he's part of the Long Now Foundation, which was established in the year 01996. Now that's 1996 for as currently we all see the world, but an extra digit was added to foster long-term thinking and responsibility in the framework of the next 10,000 years. So, what is the Long Now Foundation? Well, they're building a clock, and it's the clock of the long now. And it's also called the 10,000 year clock. And it's a proposed mechanical clock designed to keep time for 10,000 years. Now, the project to build it is part of the Long Now Foundation. So, the project was conceived by Danny Hillis in 01986. The full-size clock that's now under construction is being built in West Texas on land owned by Jeff Bezos, who is also actively helping to design the clock. So Bezos, Hillis, and others are the geniuses behind the Long Now Foundation. And the clock is currently under construction, and conceptualization of the clock is continuing. So Hillis says, "I cannot imagine the future, but I care about it. I know I am part of a story that starts long before I can remember and continues long beyond when anyone will remember me. I sense that I am alive at a time of important change, and I feel a responsibility to make sure that the change comes out well. I plant my acorns knowing that I will never live to harvest the oaks." He wanted to build a clock that ticks once a year, the century hand advances once every 100 years, and the cuckoo comes out on the millennium. "I want the cuckoo to come out every millennium for the next 10,000 years, Willis says. So, this course is going to be really, really deep for you. So, you may need to kind of reset the scales a little, move that decimal place over 1 and just times everything by 10 or 100. So here's the action item today. Make a prediction in your market more than 2 years away. This could be flying cars in 2024. I think Uber's got a project in the works. So make it fun. You want this to be fun to speculate. And the more you do it, the less surprised you'll be about your future. So have fun speculating, and I'll see you all next week.